All right, Abel Pacheco, welcome to the Five Talents Podcast. We are super excited today to have Nick Aiola. He's here with us in the flesh, virtually from all the way from the East Coast, coming over to Texas. So what's up, Nick? How's it going, bro?
Thanks so much for having me, Abel. Yeah, awesome to be here.
Oh man, we're excited. I think our friends over in the legal side of Mr. Brian Bradley, originally introduced us to Nick, and what I asked was, "Hey, who else do you know in the realm that's super reputable, super trustworthy, and somebody that can help some investors really create, build, preserve wealth, and it's got some good strategies?" And he's like, "Oh, you need to talk to Nick." So I said, "All right, I'm excited to." But if you don't know him, we'll connect with show notes and all those things in the podcast. You go look it up, check him out. But we're blessed to have him on our show now and talk a little bit about the goodness that they provide and the some of the strategies that we all should be leveraging in our investing arena. So Nick, man, let me turn it over to you for a second. In your own words, tell us who you are, what you do, and we'll just start a great conversation.
Yeah, absolutely. So first, thank Brian again for introducing us. He's a great guy. I go to him for any legal questions too. So I encourage everybody listening to go check out that episode too, because he's a wealth of knowledge. But yeah, as far as myself, I own and run and operate a virtual CPA firm. So we're 100% virtual. We have clients, and our team is all over the nation. We specifically work with real estate investors and real estate businesses to help these investors and business owners, like you said, able to grow wealth and keep it. People work hard for their money. You want to make sure that you don't pay more than you need to the IRS and your state governments, because most people's biggest expense is tax. So how do we help you save that? And we focus on being proactive. We're a proactive advisory firm first. We do tax prep as well, bookkeeping, financial reporting. But our main goal is to be able to work with you throughout the year. That way, when we get to the end of the year, you don't have a surprise tax bill, and we get to keep some of that money in your pocket. So that's our focus, and no better way to do that than real estate.
I love it. Yeah, that's it, man. That's no better way to do it than real estate. Whenever I hear one of the experts in the arenas that I say, I'm not a lawyer, I'm not a CPA, talk to your professional, consult with them. And now hearing is like, hey, there's no better way to do it. I'm like, this is exactly what I want to hear, man. This, as somebody who's trying to create their wealth, like this is what I want to know, man. We've been grinding for years in the real estate.
Tried and true. Yeah. So tax advantaged. I mean, investing in it is tax advantage. Exits are tax advantage, and you have options. That's what I always tell people is, our job as professionals, and that goes for, I'll take a liberty and speak for other service professionals as well, but our job is to provide you with options so that way you can make informed decisions, right? We provide you options of what you can do, what's available to you, pros and cons of each, and then you have the tools at your disposal to make the correct path for you, because everybody's different. And that's how it works with tax. You and your best friend could have the exact same investments, but if you have anything else that's different in your tax situation, it'll affect you differently. Or how you spend your time in the investments affects things differently. So we look at every single investor, every single individual's tax situation separately, and how do we maximize that? So it keeps it interesting, that's for sure.
Yeah, absolutely. On this note, it's November 2022, November the 7th as we record this, and I'm sure the show will air in a week or two or something. And people are thinking about like, wow, man, taxes. I don't do taxes till April. And then some people go, you know what? I do an extension till October. But there are actually a couple months where people can still make a move to affect their 2022 taxes. And one of the things that when I ask a lot of people is like, well, how often do you meet with your advisors? And they go, well, I do taxes once a year. And I go, well, first thing is you need to stop waiting for the next year in advance for April. You need to meet with them in the year that you're doing business, and a few times a month, a few times a year if possible, right up until the end, and figure out what you want to pay in taxes versus what you owe in taxes. And a lot of times they go, what the heck do you mean? It's like, man, we decide how much we pay and determined by the last few months of the year, right? So maybe you can elaborate on this mindset from your voice as a professional. What the heck does that mean? What choosing to
Yeah,
pay versus having to owe?
it's so true because the worst thing that you can do as a taxpayer is go to your CPA after the year's over and say, here's everything that happened last year. How do I lower my taxes? Because at that time, there's maybe one or two things you can do before you file in April, but nothing really impactful or meaningful comparatively with what we can do if we have proactive discussions, because at that point, the year's already over. You can't go backwards and rewrite history. So our focus is exactly that. Let's check in. Let's run some tax projections. Let's see what your goal is. Are you planning to continue to invest? Are you scaling up your business? Are you starting a new business? What does this year look like for you? Also, what are your goals, not only this year, but in following years? What does that look like for you as well? So we want to make sure that we're on track to hit whatever your individual goals are. Tax is one component of everything. So we want to make sure that it's an important component, but it is one component. So we want to make sure that holistically we're looking at everything and seeing what makes the most sense. But the idea being, yes, is there certain actions you can take before the year end to get you closer to that where you want to be tax wise? Can we get you to a net zero? You don't really want to be extremely overpaid, because that means you basically gave the government an interest-free loan for the year. You don't want to owe a ton of money either, unless you have use for the money and you can spend it throughout the year and beat the penalties the IRS is going to charge you. That's another story. But ideally, you want to operate right at as close to a break even as possible. And how do we get there most efficiently? And it's the only way to do that is to be proactive and talk throughout the year. So we focus heavily on that.
Yeah. Specifically with real estate, as we're kind of thinking about it, me and Nick had a quick, discussion earlier. He was talking about some cost segregation, bonus depreciation, some of this accelerated depreciation. These terms, if you've heard them before, great. If you've never heard them before, even better. If you have used them, but just kind of you're trying to, put it all together. Nick, maybe give somebody that's listening an idea, and maybe even I'll preface. We've got a lot of high earners, high W-2 earners, high net worth, individuals, people that are making good incomes,
Mm-hmm.
200, 300, 400 plus $1,000 a year, and they're paying 40, 50, 60, $70,000 in tax bills even as a W-2 owner, not even W-2, not even as a business owner and entrepreneur. So like those
Right.
taxes are there, and there's a husband and wife. Somebody's got low paying, gig. How are people leveraging these situations with accelerated depreciation, bonus depreciation, cost X? How are they leveraging that to reduce their taxable income?
Yeah, great question. This has been my favorite topic to discuss over the past few years. And so give me the ring, cut me off if I go too long, because I can literally talk about this forever.
Good,
and
let me let you go.
It's
I
so
wound you up.
impactful.
Let me let you go now.
Yeah, it's so impactful and it's so beneficial. I'm actually a real estate investor myself. I'm in the middle of this strategy as we speak. So I practice what I preach. It's something that not only is it an extreme tax benefit, you're also building your portfolio and continuing to build your wealth. So it is very beneficial. But like you said, there's I'm sure many in the audience and so many people have high W-2 income that you really have no control about how you can reduce that income in a broad sense. Your W-2 income is what it is, right? You get the form at the end of the year. It shows your taxable wages. It shows your federal withholding. You can adjust your federal withholding throughout the year, sure, but your wages are what they are. Your employer is in control of that. So how do we reduce that? There's a few ways we can do it, and there's a few ways we can do it really, really well. And that's this area with cost segregation, bonus depreciation, and we'll get into that. In its most basic form, if you're a real estate investor, a long-term rental real estate investor, for example, a landlord, if your income is over 150,000, joint or single, you can't take any of those real estate losses that you generate from your long-term rental investments and deduct them against your W-2 income, because they're passive activities, even if you actively manage them. The only way you can do that is if you're a real estate professional, or if you have a short-term rental property and you meet a few criteria, which we'll get into. So there's two different ways where you can kind of make a real estate investment work for you, and you can use these losses to offset high W-2 income. And that's kind of what we focus on, because the higher your income, the higher your tax bracket, the more a deduction is worth to you. If you're in the 37% bracket, every dollar that you're offsetting your income is worth 37 cents, as opposed to if you're in the 10% or 12% bracket, every deduction is worth 10 or 12 cents at that point. So the more income you earn, the more these strategies are actually worth to you, because it's reducing high taxable income. So what cost segregation is, well, I'll step back for a second and go through what a scenario would look like if you didn't do a cost segregation, and where we kind of have an understanding of how impactful it is. If you were to purchase a rental property, whether it's a short-term, mid-term, long-term rental property, when you go to prepare your tax returns, your CPA should split the value of that asset into essentially two assets, the building and the land, because you can't depreciate the land, you can only depreciate the building. So we have to extract the land value. So instead, if you buy a property, for example, for $500,000, national average is around 20% to land value, 15 to 25%, somewhere in that neighborhood. So if we allocate 20% of a $500,000 property purchase to land, we have a $100,000 land asset and a $400,000 building asset. And that $400,000 building asset is what you depreciate every year over the next 27 and a half up to 39 years, depending on the use of the property. So you get a component of that write-off every year, which helps reduce your taxable income, which is great.
I'm looking at the math. I took 400K divided by 27 and a half. It's about 14,500. So 14,500 lost.
Right. So if it's around $14,000, $15,000 in this example, that means your first $14,000 or $15,000 of cash flow is tax-free, because depreciation is a non-cash expense. So you get a deduction for something you didn't actually pay for. And that's also true because you may not have bought the property in all cash, probably use leverage to buy the property, mortgage, other people's money. So you're getting a write-off for something that you may not have paid for in the form of depreciation, which means you don't pay that $14,000 or $15,000 every year. You just get that write-off.
If you're doing real estate right, you're rewinding what Nick said, and if you're doing it wrong, you need to rewind it and listen again. Which is, we're not buying cash the entire 400K property, or this example. We're using leverage, right? We're still using the bank's money, other people's money, and we're putting it all in. And essentially, we didn't pay 400K, year one, but we are getting the write-off on as we did. Okay, sorry.
Exactly. Yeah, you're exactly right. So you're getting that write-off year after year, and that's great. $15,000 per year for the next almost 3 decades is excellent. But I'm greedy sometimes when we're tax advising. How do we get more than that? How do we get more than that now? How do we make that work for you right now? So that's where we kind of stop as a CPA firm when we get that initial new acquisition. We see that closing statement, we see the purchase price, we see the closing costs, we get our land allocation by looking at the assessment or the appraisal, and we break that out, and we have 2 assets, building and land. Where the cost segregation comes in is a cost segregation is a separate professional service. It's a separate firm that'll have an engineer either physically or virtually walk through the property, and they identify every component of the home, and they break out that building value even further to every single component of the home. We're talking flooring, foundation, sheetrock, roof, cabinets, appliances, even as detailed as electrical outlets. It's very minute, and you get a 100 to 200, possibly more page report of all of these assets and descriptions and why it was broken out that way. And you have now, instead of 2 assets, now maybe you have 100 or 200 assets. And the benefit of this is that all of these assets are depreciated over a different life. So instead of the building alone being 27 and a half years, now you have some assets that are 5 years, some assets that are 7 years, some assets that are 15 years. And they're depreciated over a shorter amount of time, which means your depreciation deduction is higher. The biggest bonus, no pun intended, is that currently bonus depreciation allows you to write off 100% of the cost of the asset in the year you place it in service, if that asset's life is under 20 years. So for all those 5, 7, and 15-year assets that are broken out in the cost seg, you can write off 100% this year. Next year, it goes down to 80%. And then after that, it's 60%, and it declines by 20% per year until 2026. We don't know what's going to happen after that. That's when the law expires. So they could renew, they could bump it back up, they could keep it at zero. We don't know. So now is the best time to do this because it is a declining benefit. So keeping with that same example, if we buy a $500,000 property, generally speaking, on average, depending on where you are in the country, because land values change and types of properties change, and $500,000 can buy you 500 square feet or 4,000 square feet, depending on where you are. So depending on the property,
Yeah,
it changes.
It could. I'm gonna pause, Nick, too.
Yeah.
And what I love talking about this is like, Nick. One of the best things from our vantage is when we tell investors, oh, you could buy, the average, 500K single family house, or you can also invest in a 200 unit
Right.
Dallas property in one of the best submarkets in Dallas, Fort Worth. It's called Allen, Texas. And this property is a $43 million purchase. The reason I can talk about it openly, it's a Regulation D 506C investment. So for accredited investors, if you're interested, come connect with us. But we can literally put it in a number of different, avenues. But man, it's amazing to see this done, because even on this 400K example, let Nick continue. 14K on one hand versus the other side. Go ahead,
Versus
Nick.
the other side, yeah. And if you have if normally what you see is, give or take, possibly 15 to 25%, let's call it 20%, the purchase price of whatever property it is you're buying can be extracted as, in the cost segregation, as assets eligible for bonus depreciation. And that is a broad range. Your results may vary, of course. But if you buy a $500,000 property, and for example, we can expect maybe somewhere in the neighborhood of $100,000 of assets eligible for bonus depreciation, that's currently in this year, that's a $100,000 write-off against your income versus $14,000. It's an insane difference. Major benefit. It can really help kickstart your investing and your portfolio growth, because now, instead of having a $14,000 depreciation deduction, which is still excellent, it'll help you generate tax-free cash flow. You won't pay tax on your rental income, most likely. Or you do a cost segregation, you reduce your income significantly, and you get a major refund to help either wash, rinse, and repeat, or put into other areas of investing. So it really helps, utilize the tax code to be able to get you some more cash back in your hand. But
it's crazy. It's crazy.
It's insane benefit.
Let me just emphasize this. I'll give a couple people my example, and then I'll give another one, a common example I hear. So it was 2019 for me. I was making 300, I think about 300K, depending on how I hit my commissions. And my taxes were about 65K. My wife was working full-time W-2 at a hosting or tech company as well. Same. And she wasn't earning that much, but she was earning about 40, 50K, whatever the amount was. So I go, well, shoot, I'm paying this much in taxes. When I finally unlocked this magic, we invested 100K cash, and we got a 60% tax write-off, or 60K on my 100K. And we had enough to completely replace her income, because instead of paying it in taxes, which I was feeling on one side, and then her making money on this side, I was like, well, you mean it's a freaking wash? Like I wipe out, remove, completely negate all of my taxable income so my wife can stay home. And that's what she did. She stayed home with we have our almost 5-year-old daughter now. And I guess it's 2018. Now that I think about it. So anyways, she was able to stay home with our daughter the first year. She's still at the house right now. So that's how we technically retired my wife. Yeah.
Yeah. That's
it's nuts.
I love to hear that. That's exactly how you have to think about it. Is you're looking at everything from a net effect. I mean, of course, maybe you put 100. Yeah, maybe you put 100K into a property worth X. Who knows what it was worth, and then you got 60% of your down payment back, basically. So that's in your sense, yes, you were able to retire your wife. That's excellent. That's a personal goal.
We have investors that are making 400 or 500K a year, and they're literally tax bills are like 150K or whatever.
I see it every day. Yeah, it's crazy how much you can save is insane. But the most important piece of this conversation, Abel, is now you can do this with any property you acquire, right? You can go buy a long-term property and you can go do this cost segregation. But the key to making it offset your W-2 income is how you participate in that activity. You have to either be a real estate professional, which is hard to do. If you have a full-time job, if both spouses have a full-time job, not going to happen.
Right?
So there's when one spouse doesn't work, it makes it easier because you can have that spouse focus on being a full-time real estate professional. And if that's not possible, there's a second way, which is a lower barrier to entry into this strategy, but it involves Airbnb, short-term rentals. And that's exactly what I'm in the middle of. So if you can't qualify as a real estate professional, you can do this exact same strategy with short-term rental properties, because as long as certain criteria are met, it's considered non-passive without you having to meet the criteria of a real estate professional, which is over 50% of your time and over 750 hours in the year. So you don't have to do all that. You can hit certain criteria, which we'll talk about, and you can get the same exact benefit. But the key is you have to spend your time doing so in the first year, really get that benefit, basically bite the bullet, self-manage a short-term rental property. And then in the second year and onward, if you desire us to hold it, we could talk about converting it to a long-term rental property, converting it to a mid-term rental property, hiring a property manager or a co-host to help you out with the time, because it's a lot of work to help you out with time requirements. But the point is you can mold the investment, which goes back to what you said, Abel. What do you want to pay in tax, right? What do you want to pay? We can mold that investment and mold the strategy to fit exactly how you want it to look both now and in the future, and get these major tax benefits along the way.
Husband and wife teams work amazing, don't they?
Amazing. Yeah, amazing.
If you're a high earner, whether you or your spouse, right? One or the other. One's crushing it, W-2, and IRS is crushing you because of it, and the other individual is not making very much or less, a much lower amount, you need to look at the net, because one of you may very well be working when you don't have to. And that was, that was my example. It's like, man, my wife didn't have to work, and there was actually no change. In fact, there's a bigger swing the first year we did this, which I didn't realize. Anybody that's listening right now, if you're a high earner and your spouse is not, go look at your W-2 withholdings amounts. The government's been taking money out of your check to make sure you have enough to pay for your tax bill. Well, that withholding amount in my example was like 30-ish K. So not only did we not pay any taxes, so 60K negated. My wife stayed home. So she didn't make 60, but I didn't pay 60. So that was like a wash. However, the government took out another 30-something thousand dollars in withholdings to like prepare you. And that's the refund check that I got back that year. And for me, when I go, well, shoot, I put 100K down, I negated 60, and I got a 30K withholdings check. That felt like a 90% cash on cash return, because I'd never been able to put 100K anywhere and get 90K back, and the 100 still keep working. It was
exactly
nuts.
You basically got a property for free.
Oh, I go, okay. And that property was 128 unit apartment complex that I didn't have to manage or spend any of my time. So for anybody that's freaking listening, like if you're not doing some of these strategies, you got to figure out how to become a real estate professional. Number one, either go, do a short-term rental, buy the bullet and do one so you can qualify in that first year. Take any of your remaining tax budget, tax bracket, tax income, all this. You talk to a professional. How much am I really going to owe? And then put the rest in a syndication, passive. Whether it's with us or anybody else. The point is, go passive. You don't want to put your time, effort, energy. You make a ton of money on one side. Don't start trading your time for a $12 an hour painting job, right? Don't do that. But you need to figure out how to avoid those taxes. And maybe that's a husband and wife. One of the spouses stays home and just retire yourself and go become the real estate professional. You don't have to be a licensed person or anything like that. It's just, you got to be qualified. So talk to CPA and say, how do I qualify? And if they say you can't, you need to choose a different CPA and ask them the question, how do I qualify is what I asked.
Yeah, how do we make it work? How do we
How
make it
do we
work?
do that? So yeah,
And that's interesting you bring it up about basically moving everything into passive eventually, because that's generally where it winds up. That's the natural trajectory, right? I mean, as far if you read the tax code is a set of directions. It's a set of incentives that if you know how to follow it, you get rewarded for it. And the IRS is telling you where they want you to put their money. They're rewarding you for putting your money where they want you to put the money. Real estate
yeah,
is one of those, extremely tax advantaged. So the way we kind of look at the hierarchy of the tax code is that W-2 employees are on the bottom. Almost no flexibility, can't deduct business expenses against your income. Very, it's whatever's reported on the W-2 is reported on the tax return. There's no flexibility there. So W-2, you're the most inflexible, and you wind up paying the most percentage in tax, usually based on the amount of income you earn. A step up from that is self-employed individual. A step up from that is a business owner who employs others. And then finally, a full-time investor. So as you kind of move up that scale, and maybe you have a W-2 job and your goal is financial freedom and you want to scale back, maybe become self-employed or maybe employ others and start a business as an entrepreneur, or maybe just shift directly to full-time real estate investor or any kind of investor, really. That's where you have the most flexibility to tax plan, because it's tax advantage to begin with and you have more options at your disposal. It's not like you're going to a 9 to 5 and collecting a paycheck and you can't write anything off against it. You have the entire tax code at your fingertips, which makes it easier for us to plan for and much more valuable for you, because you're not paying tax on income that you're replacing. And your example is a prime example of that, where your wife stopped working. She didn't pay any tax because she didn't have any W-2 income. You paid less tax and you got an investment out of it. So it's a home run.
Take a big swing. We have literally you have a month and a half ish to make a move. And all joking aside and all seriousness, and I'm smiling ear to ear because there's that deal that's live. If anybody's interested in investing, we've got open spot right now. We actually closed this deal in September, which is pretty nutty. It was like we closed this $43 million deal. We raised a ton of capital, $19 million. And at the very end, we came down to this wire, and everything you see with the interest rates and people freaking out. It's the majority of our capital, almost all of it, came from retail investors. So it wasn't a big private equity fund, or it wasn't preferred equity or anything like this. Just just retail investors, people like everyday average accredited investors, and we were all jumping in the deal. We were tight at the end, so our general partner team decided to fund it and close it. So we've had the asset for
excellent,
2 months, so it's already there. It's a bird in the hand as opposed to something in the nest. If you need a loss before the end of the year, our cost segregation report looks really amazing. It's probably like 40-ish%. So somebody
once you get into those, once you get into those higher multifamily, you're talking 35-40%. Mobile home parks are extremely advantageous as well. Yeah, it's great benefit.
Well, how does that work that way? I'm like, yes, put in $1 million and the projection, my lawyers will, let's say it's projected, all this stuff, but I'm like, well, projected at 40%. That's a great, taxable relief, taxable income relief for somebody. But anyways, with the last few minutes, I want to make sure, we do this. Anybody that's looking to reach out to you, Nick, who do you want to reach out to you? And where do they go? Where should they be connecting with you?
Yeah, so the best place to reach us is our website. It's aiolacpa.com, AIOLA CPA.com. It has all of our contact info on there, meeting scheduling links, anything you could want is on that site. That's the best place to reach us, and especially able, like you said, approaching the end of the year. Now's the time to do it. Don't wait till the end of the year. And if it's not us, if you currently are working with a CPA you're happy with, that's great. Reach out to them. Whoever it is that you're working with professionally, make sure you have 2 months left. Make sure you can make the best use out of them as you can.
You still got time. You still have time.
Still got time.
Jump, right? Make a move. Inflation is 9+%, whatever the projected number versus the actual, who knows? But your money sitting in a bank account is
losing money,
wearing away. And what Nick just described is what a lot of times when I share this stage, I was with individuals. I've been going to these real estate conferences lately. It's been really fun. I got to share the stage with Shaq at
Oh,
the
cool.
Multifamily Investor Nation in North Carolina. Barbara Corcoran was there as well, and we talk about this stuff. Recently, we were in Vegas this last this weekend, 2 days ago. Ty Lopez was there, Jerome Maldonado. We had Cody Sperber. We had Eric Thomas, the number one motivational speaker in the country.
Yeah, he's
He was
great.
there, and it's these things that we're talking about that shocking people. That you're like, dude, you can have some massive tax deductions. It's not how much you make, it's how much you keep. And sometimes people worry about the difference between 9% and 10%, 12%. These deals that we were doing, Nick, syndications, multifamily, 100 plus unit, 2 or 3 years ago, they were like 17, 18, 19, 20%. And now they've shrunk, everything's squeezed.
Sure.
And my OMs are like 14, 15, 16. Sometimes we get a little higher. But I tell people that, to me, now that I realize this, that's the icing. The cake is 40% loss in the beginning.
Right.
Where else are you going to put your money and get a 40% cash on cash? Like today, the way I measure it, either you pay the government or you keep it. And so that's the cake. The icing is just a return.
You're right. And it's like I always say that as a tax advisor, I can recommend all the, if you Google year-end tax saving tips, you'll probably see a million blogs with the same generic advice. Accelerate deductions, defer income, contribute to your pre-tax benefits at work, or if you're self-employed, your solo 401k, all that. That's all great advice. It's not to knock that advice, but you have to pay the money to get those benefits. You have to pay the dollar to save your 40 cents. If you're making an investment and you're saving multiples of that, it's not a contest. It's no contest. So yeah, I totally agree that on one hand, you never want the tax tail to wag the dog. You don't want that to be the only reason you make an investment. With a strategy this impactful, it's a huge component of investing. And like I said, it's bonus depreciation is currently declining 20% per year, starting next year. So now is the time. Don't wait.
Well, good deal. Well, man, there's so much more I wanted to talk about.
Goes fast. I know.
We're here at time, man. It's let me just turn it over one more time. Is there anything we did not get to talk about that you were just like itching to share, or anything that I didn't get to ask about?
Oh man, yeah. Like I said, I could talk about this forever, so I could go on forever. But I'd say the biggest thing probably is the qualifications. I'll put a disclaimer out there. If you are a real estate professional, or if you acquired a short-term rental property this year, you need to talk to a professional before the end of the year. The pros, the upside is too big for you to risk losing, even if it's just a consultation. So you need to make sure you know those qualifications and what it means to be a real estate professional, or what it means to take advantage of a short-term rental, because they're very strict qualifications and criteria that you have to hit, and it's very black and white. So absolutely, that's the one thing we didn't get to, is how to actually qualify. But I would absolutely recommend speaking to a professional that is familiar with real estate to guide you, make sure you're on the right track.
Right on. Well, this has been awesome. Thanks a lot, Nick. We appreciate it. Well, another great episode at the Five Talents podcast. We are super excited to have you. We've just crossed, I think, 218 or 19 shows. We are in our second, or actually, I think this is season 3. I don't know how many years we've been doing it, but season 3, and we've gotten 5.0 ratings, 114 5-star ratings. So let me just take a moment to thank everyone that's said some good stuff. We haven't gotten any 4-star, 3-star, 2 or 1s. So in my opinion, I think this means we don't have enough reviews. So I would love to have 1,000 reviews and have a few 4-star. So if you're listening now, I really appreciate it if you left a 5-star. I'm not telling you don't leave a 5. What I'm telling you is that I'm sure there's some listeners here that was like, you got some positive feedback for us, which ways we can help you, advise you, continue to grow. We want to hear it, good or bad. So I don't mind if you ding us, just leave some feedback, leave some more reviews, tell us what we need to be doing for you. And if you want more guests like Nick, it's this stuff that really helps us. We just crossed 30,000 subscribers, downloads a month. So we're really in the groove, starting to grow, and we just want to get more information that you would value. So keep giving us the insight. Thank you for the reviews, and if you are a 5-star and you left us a good review, thank you very much. So thank you. Talk to you soon. See you on our next show.